but we've seen quite the opposite. There's been a massive spike higher on a relative basis in bond yields, and therefore bonds have not provided the safety. And then the dollar, which normally will rally as a safe haven currency, when the global financial markets are in crisis, has actually gotten pummeled quite dramatically. These are the kinds of things you see in a emerging markets that's going through a balance of payments crisis, a currency crisis. This is not what normally you see in quality United States. And I think a lot of this is policy driven.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Welcoming you here back with another monthly check-in with the team at New Harbor Financial. They're one of the endorsed financial advisory firms by Thoughtful Money. They come on this channel with me every week to make sense of what the markets have been up to on a weekly basis, but we've started this new process of having them on once a month to kind of just do a deeper dive in terms of how they see the world. And gentlemen, there's been no shortage of things to focus on since your last appearance here. They've got that expression, was it April is the cruelest month, I think? Hopefully I'm not confusing that with August. But it has been a crazy month, a lot of whipsawing, a lot of uncertainty, inflaming emotions, which we're going to talk about in just a moment. But folks, as usual, I'm joined by John Lodra and Mike Preston, the senior partners there at New Harbor Financial. John, why don't we start with you? When we were getting ready to turn the cameras on here, you said that we're starting to sort of see the markets behave, in the US at least, in the way that you oftentimes will see them behave in like emerging markets, those kind of banana republic type markets. Do you want to elaborate on that?
Yeah, so Adam, great to be with you, and hello everybody. Thanks for tuning in. April's been a tremendously uncertain and volatile month, not just in the data, but in the emotions. In our work, we deal with real people, and even though our client accounts have been rather stable, we've done a very good job at protecting and mitigating a lot of this volatility. It doesn't change the emotional angst that we humans are destined to feel, because it is a very uncertain time. Howard Marks, legendary credit investor, I think put it best. He recycled the title he's used only a few times in history, this in his recent memo, called "Nobody Knows." And the reality is, we have a situation here where there are self-inflicted changes from a policy standpoint that are just curveballs left and right, walking forward and back and different corners. And if there's one thing that markets and humans hate is uncertainty. It's a scary concept for human beings. I'd like to share just a picture that appeared in a recent Financial Times article, and I think this puts in the context when I talked about the U.S. Kind of behaving like an emerging market, banana republic. What this shows is it shows the recent kind of moves under Trump so far in red, both with stocks, bond yields, and the U.S. dollar, and it compares it to the crises in the COVID pandemic and the global financial crisis. And normally what you would see, everybody knows that's got a pulse that the stock market sold off pretty healthily. In fact, we during April reached the definition of a bear market, over 20% pullback, just from the top. Even in April alone, I think at one point the market was down over 10%. I think the worst since 1929. So definitely the market has fallen. But usually when you see that happen, you see bond yields drop as well, as there's a flight to safety in treasury bonds, because when bond yields fall, bond prices go up. But we've seen quite the opposite. There's been a massive spike higher on a relative basis in bond yields, and therefore bonds have not provided the safety. And then the dollar, which normally will rally as a safe haven currency, when the global financial markets are in crisis, has actually gotten pummeled quite dramatically. These are the kinds of things you see in a emerging markets that's going through a balance of payments crisis, a currency crisis. This is not what normally you see in the quality United States. And I think a lot of this is policy driven. When you get such uncertain kind of, Liberation Day, everybody knew Trump was going to be announcing some tariffs. That was April 2nd. And we'll get into some charts in a little bit that shows what the month actually did. But what came out in April, on April 2nd, was far more punitive and dramatic than what anybody thought, right? So, and if you look at a chart of tariff history in the United States, it blew away like where the headline tariffs were in the Smoot-Hawley era in the Great Depression. So, yeah, this has translated into very volatile markets, very, very tense emotions, and we're having conversations every day, as Mike said, with our clients and prospective clients, and they would be forgiven to feel this way, even if the relative moves in their accounts have been rather minor. I would like to get later on into some of the bond market dynamics because that's ultimately the straw that broke the camel's back. I think Trump and Bissett have been talking a very good game about, hey, we're going to let the markets kind of feel some pain for a little while because we got to get the deficit down, we got to get the budget under control, and after that, we'll have a brand new awakening, a bright new horizon. And everybody's guess was, okay, how long before the stock market drops before Trump freaks out? It's really the bond market, we think, that really caused the freak out, because the bond market was really on the verge of a utter collapse, and that's not a hyperbole. There were some real stressful things going on in the bond market that you just don't see in a normal course of action.
And John, let's actually talk about that just for a sec. I asked this question of Lance Roberts the other day. Love to hear your thoughts on it. And I think what's interesting is a lot of stress in the bond market when yields had risen back up to 4.5%, right? And we saw bond yields higher than that, not that long ago. The bond market was trading at 5% in the 10-year. So the question was, well, why is 4.5% much more existentially a threat than 5%? And it basically has to do with the speed at which these interest rates have moved, correct?
That's right, Adam. And one thing I'm going to pull up a chart here just so it can give some context. This is a chart of the 10-year Treasury bond, okay, bond yield. And this is off by a decimal place. So, for example, on January 14th, we saw a yield of 4.8 on the 10-year Treasury bond. And then we saw a pretty organized trending down of those yields. In fact, they reached a low of, on April 4th, they reached a low of, they actually dipped below 4% very briefly. And then Liberation Day came, it was right there. In the wake of Liberation Day, we saw a spike higher, probably quicker than we've seen in any, recent history, and maybe, on the top 10 of all time. That's a dramatic spike. So even though it didn't take out that prior high of 4.8 in January, the speed and the slope of which they rose was very unsettling to the market, and it was probably destined to go a lot higher if there wasn't some walk back. So here we are trying to find some footing here. We're seeing bond yields kind of spike again here today. Actually, they pulled back off, but they're off, certainly off the lows of today. But what I want to share here, I'm going to go to another page here, because it's the steepening of the curve that has really rattled the market. So let's go here.
Okay. And I'm just going to mention something that you can then address as you explain, John. So there's sort of two things going on. One is a longer term, well, yeah, relatively longer term threat, which is the higher that the bond yields go, the more that the U.S. has to pay in interest expense on its debt, which, anybody who's been reading the headlines for the past, year plus knows that our interest service on the national debt has ballooned, right? From the old ZIRP days to where we are now with interest rates. But the speed of that spike in yields that you just walked us through that happened over a matter of days, that's kind of immaterial in terms of its immediate impact on things like the national debt service. That's more of a threat because you have what's called the basis trade, which is this trade where a bunch of big hedge funds are buying quote unquote safe treasuries, but then they're jacking up the yields or their returns with a ton of leverage. And that trade works fine as long as things remain stable. But if things shift as quickly as they did, which they rarely do in the treasury market, those firms found themselves underwater on a trade using a lot of leverage. And so, we didn't have perfect visibility on what was going on behind the scenes, but we could kind of tell that some of those big firms were really struggling and probably having to force liquidate some of their treasuries, which was also continuing to push yields up. So I just want to make sure that however you answer this, you kind of differentiate between those two effects.
Yep, absolutely. That is that was one symptomology of this run up of the bond. If we didn't get the spike in bond yields, that kind of leverage wouldn't have been a problem, right? Because everything was stable, right? It's the instability and the quick moves that caused that quote unquote risk-free basis trade to become suddenly very risky and very levered risky in a big way. And that's quite sure Scott Bessent, Treasury Secretary, he's a very seasoned market practitioner. I'm quite sure he probably barged into Trump's office and said, we got to get this under control. Stock market falling is one thing, but bond market freaking out is a totally another thing. And yeah, so that's a key part. Let me share this chart here because this I think speaks to, because one of the main policy pillars of the administration is we got to get longer term yields down. And how do we do that? We do it by cutting the deficit. We do it by cutting spending, and all great ideas, right? Who doesn't want to see our long-term interest rates go down? But actually, quite the opposite has happened. And I'm going to share this chart to put it into context. So this chart, there's three dates here, three colored lines. The green line is, remember I just showed you where 10-year yields peaked earlier this year at 4.8. That was on January 14th. So I've got the rate curve January 13th here. And this shows for different maturities. So this is the overnight rate here, short-term rate, 1 month, 2 month, all the way up to 30 years. And here's the rate here. So, we had a fairly normal upward sloping yield curve where longer term rates were higher than shorter term. That's about as normal a yield curve we've seen any time in the last bunch of years in terms of, much of the last year it's been inverted where long-term rates were vastly lower than short-term rates. Fast forward to Liberation Day, which is the red line. So we saw yields between the January and Liberation Day drop substantially across the whole curve, from 1 year all the way out to 30 years. A little bit more in the belly here than some of the longer date. But look what's happened since Liberation Day. And this shows as of a couple days ago, the 21st of April. You had the belly of the curve continue to drop, but you've seen the long end 20, 30-year rates spike dramatically, almost to unchanged since early in January. That's the part that is, we've seen a massive steepening. And I'll tell you what, the one of the reasons we believe, and the market I think believes, rates have gone like they have is the outward antagonism between Trump and Jay Powell, the Fed chair. We've been longtime critics of the Fed, so we're not giving the Fed any free passes here. But the manner in which the schoolyard bullying to drop rates, short-term rates now, you're too late, using words like loser. I mean, this is the kind of stuff that causes the rest of the world to say, you know what, this is not the United States. This is a banana republic. This is not the stability that we've come to, price into U.S. assets and the predictability. And that's what has freaked out markets. I tell you what, if Powell caved in and dropped short-term rates, I think we would have seen this bond curve go ballistic in terms of shoot up higher in the long end. Some speculation of sorts, but there's some good basis for that.
And would the rationale of that have been the Fed is no longer independent, Powell is just a puppet doing whatever the president commands of him, and that's why investors would get worried?
Well, we've had a dollar collapsing, right? One way to hasten a collapse of the currency further is to lower rates.
Is to keep lowering rates, yeah.
Yeah, I mean, part of the way to stem a currency crisis or sell-off is to make it more productive to own the currency with short-term rates being higher.
Yeah.
And Powell came up pretty hawkishly, I think it was last week in his meeting. So there is this standoff between President Trump and Jay Powell, threatening to fire, threatening with schoolyard bullying words. And this has got the world rattled for good reasons. And there's a whole nother facet of the bond market called the term premium. I might as well just show that quickly here, just to kind of finish the thought.
As you're pulling it up, let me just also, there's another potential factor here, which I think is mostly just speculation. I don't know if we have a lot of data on it, but is that there may be some selling of treasuries by China as a way to sort of send a signal during these rough trade disputes between the U.S. and China, for China to say like, hey, look, don't push me too much because I've got a ton of your treasuries and I can dump them if I want to.
Absolutely. I don't have hard data on that, but I think that's definitely a factor here. I just mentioned the term premium. So typically what drives bond prices is economic, growth and inflation expectations. But there's this other thing called the term premium, which is a little bit of an esoteric kind of theoretical concept, but it's the same idea as stock investors demanding a premium to invest in stocks, a risk adjustment premium. So stocks are inherently riskier than bonds, or they're supposed to be. So they commanded a premium, a risk premium over bonds. Now, U.S. Treasury bonds have always been considered a very safe asset. So the risk premium for those has been relatively low historically, and especially in the wake of the GFC when the Fed was monetizing the debt by printing money out of thin air, the risk premium dropped quite considerably. Lately, we've seen that risk premium spike. This is the risk premium on a 10-year Treasury bond, and it's called the term premium. And right when the Fed started cutting in September, that shot up pretty dramatically. And then as interest rates pulled back from early January to, through March, and then shot back up, we've seen this term premium shoot back up. Now, to put that in context, I'm going to go long. This is a long-term history going back to the early 90s. You can see prior to the GFC here, the normal term premium was between, say 1.5%, probably averaged. We're still only at 0.5%. So there's, irrespective of growth and inflation concerns or expectations, there still is this wild card about the world's perception of the safety of U.S. Treasury bonds. And that is expressed in this thing called the term premium. So there is still this upside risk to bonds just simply related to that. And the policy maneuvers and the way they've been dished out and walked back so violently and unpredictably certainly hasn't been helpful to that. So hopefully they get that kind of chaotic, kind of mannerism out of the way here, because it's not, the world is saying, we don't care if you're Republican, Democrat, we don't care if you're American or whatever. The markets are pushing back.
Yeah. And one of the things we're seeing in the market as a result of that is a lot more, the term premium, you can sort of say is it's a measure to a degree of uncertainty, right? Hey, we feel less certain, we want more of a premium on these bonds. But we're seeing similar things like in the VIX, which is a measure of volatility. VIX has spiked. We've seen gold, which is typically a safe haven trade when things get worrisome. That's gone bananas. And Mike, I am coming to you, buddy, and we're going to talk about that in just a minute. And you get a chance to opine on anything that John and I have said. Right before I hand you the baton, Mike, real quick, John, I'd just like to get your thoughts on this, and then Mike can get your thoughts on it. Yes. So in many ways, Trump and his new administration, they have taken the snow globe of the world, if you will, and given it a real vigorous shake, right? And now we're hopefully watching the flakes, start to settle, right? Obviously and understandably, a lot of people have said, "Oh my gosh, this is a brute force, no critical thinking move by the administration, and they're just, breaking alliances right and left, and this is ham-fisted, and this is creating a lot of excess uncertainty. It's an own goal. We're only injuring ourselves," and there's a lot of, I think, validity to a lot of those points. On the flip side, if you were to talk to the administration, which I don't, but I actually do listen to them every day because they are in front of the camera all the time, especially not just the president, but Scott Bessent, who is in charge, kind of leading the trade negotiation effort right now. And I think what they would say is, hey, look, we had this unfair status quo that had accreted over time, and we needed to move to something better for America. And we looked at it and said, you know what? For whatever reasons, we don't have the time, or we don't think it's the right process to try to incrementally fix this. We just need to break it, and then try to force a realigning quickly, right? And so, of course, the world accustomed to the status quo gets disrupted. Everybody's kind of freaking out. And this is that interim period that the administration's talking about, that detox period is how Bessent has referred to it. And what they would say is, yes, we understand that we've just kicked a lot of dust up in the air, and therefore, bond yields should go up because there's more uncertainty. But as the dust starts to settle, we're going to end up with much better trade deals with all these other countries. We're also going to get them aligned to kind of ring fence China and bring China a bit more under control, both as a trade partner who we think has had, the worst of the trade practices, as well as maybe defang their military threat a little bit. And coming out of that too, we're going to have a much greater investment in the US. We have all these deals that are starting to get announced of companies and countries committing hundreds of billions of dollars or more to building factories and employing Americans here. If any of these baseline 10% tariffs remain, that's just going to be a revenue source for America coming in. So they're basically saying, look, there's a much better tomorrow that we're getting to. So just like hang with us. Yeah, this might last for a couple of months, but don't, as these deals start getting struck, you're going to see, where it's going to get clear where we're going to be ending up here, and it's going to be a better place. That's what they would say. I think we're in that awkward point in the middle right now where there's still so much dust and we don't have any of these deals signed yet, these new trade deals signed yet. So they're kind of asking the populace to take it on faith. Do you have a personal opinion as best you can see through the smoke right now, John, in terms of which side it's more like? Is it just the ham-fisted brute who doesn't really know what they're doing, or is it, this grand game of chess and this is just the part where you can't see the whole chessboard yet?
Look, I and we aren't global trade experts, far from it. I think most people can appreciate that there are imbalances that have built up over many decades that deserve some thoughtful reconciliation. I think probably what we're seeing here is a protest to the stylistic way in which it's being done, and even down to words being used. I mean, ultimately, we're talking about humans here, and certainly in the line of work we do, we interact with humans all day long. It's interpersonal. And what is the biggest enemy to interpersonal relations? It's lack of trust, right? If you can't trust who you're looking at, who you're talking to, it's unproductive. And I think that's what the market is expressing. And it speaks to a bigger, paradigm. You think about all the talk about the BRICS currency movement over the last several years. Why is that? Because the world has gotten untrustful to the US and its bully pulpit using its currency as a tool. When the US sanctioned Russia, for example, not going to opine whether it was right or wrong, because obviously there's some
Right.
cases to be
So,
made.
sorry to interrupt. Not necessarily sanction. I think you mean when we froze their assets.
Yeah, froze the assets. This is a symptomology of a world that is increasingly restless about being controlled by the U.S. and the dollar, dominance and all this stuff. And this certainly isn't helpful to that. It's rattling things, and I think it's a lot, again, stylistic more than anything. Just my opinion.
Okay. Let me ask you this. So, yeah, stylistically, totally understand why a lot of people aren't comfortable with what's going on. Let's say it works, right? So we emerge in a couple of months with a lot more clarity, with a lot of the benefits that I just mentioned the administration is telling us to expect. Will the current, if that were to have happened, would you think that then the current dyspepsia and pain and uncertainty that the markets are experiencing will have been worth it? Will that have been enough of a price to pay?
I think the rubber meets the road by have every day's people's lives gotten better. I think the last decade has been a lot of people have felt left out as big banks have gotten bailed out. High earners have gotten tax cuts under the theory of, hey, trickle down economics. I think we're at a very important tipping point in the fourth turning kind of episode where the people on the streets got to feel it. If they don't feel like their life is better, no, it's none of this is going to have been worth it.
Got it. Right. But if, and look, we don't know, so we'll watch and see. I think the administration would say, well, if you get more better jobs here in America and people get better wages and, our jobs aren't getting, we're not hollowing out our manufacturing base anymore. In fact, we're building it, all that stuff. I think they would say that is what they're trying to accomplish, and hopefully that would make a lot of people's lives better, at least on the Main Street side, which of course they're saying, okay, Wall Street's hit its time in the sun, now it's time for Main Street. We'll see. Again, not trying to champion what they're doing, just trying to explain the logic as I've heard it. To your point, I totally agree. None of it matters if we don't see those benefits. So, it's going to take a little while. We'll see. Mike, we're coming to you now. We'll do the gold discussion, but real quick, anything you want to add to what John and I have been discussing here?
No, I think you covered it pretty well. The real question is Main Street really going to benefit from this? You guys were just talking about that. I'll give you my hunch. My hunch is no. I think it's probably more show than anything, and I think that's probably sadly the truth that you really can't unwind 4 decades of offshoring overnight. It's a good first step. I hope that Main Street has helped, but I'm a little bit pessimistic. We'll see.
Well, history is on your side, right? We've talked a lot about no matter what policies were pursued over the past several decades, uh, whether the specific policy in this specific moment was the right one or not, the outcome kind of along the way was just that capital always got its fortunes improved and labor was the one that paid the price. So
Mm.
Unless they can really break that cycle, yeah, maybe just expect more of the same.
I agree.
All
Yeah,
right. Well,
I
look,
agree.
I mentioned one of the things that was likely sort of a pressure valve to all of the forces that John was describing was the price of gold. That gold was starting to reflect greater uncertainty. Obviously, it had a safe haven bid, but as the dollar started weakening and maybe people are starting to question America's the prominence of America's role in the future of global relations. Maybe what was serving as the mirror to all those concerns was the price of gold. And you can bring up the charts and talk about it, but I mean, gold, uh, as a gold owner, I think we've all loved how far and fast gold has moved, but it got to the point where, much of the past week, I was sort of beginning to put out there on X, hey, this is really fun, but at the same time, I'm getting increasingly concerned that gold is sending a warning that like something systemic is in danger of breaking because we just sliced through 3,000 bucks an ounce, and just 24 hours ago or 48 hours ago, the futures market hit $3,500 an ounce. Gold at that point was up like 600 bucks an ounce within less than 2 weeks, which if you follow gold, and we've never seen anything like that before. So anyways, what are you taking from the gold action right now, Mike?
Well, it really, by the way, hello, Adam. Nice to be here again. It certainly has been a historic run, and there's been a lot of emotion that comes out when you see these types of runs. A lot of our clients, people that we talk to, are concerned about the speed of the move. In fact, a number of people say that a vertical gold market or a spiking price like we've seen is a harbinger of some bad things that are yet to happen. I don't know if that we believe that. I think that gold and silver, precious metals, commodities in general have a long history of having parabolic sudden moves. So I'm going to share a chart of gold here in just a minute to go over a couple key points. I don't know that there's anything imminently bad that the gold market is really signaling here, but it has been a really good move. And I'd like to talk about some key levels, the way that we see it, and so that hopefully it can help the viewers, make some decisions. And like usual, feel free to reach out to us if you want to talk through any of these things. So here's a chart coming up in just a second of gold. This is the gold of GLD ETF. It's the same shape as spot price itself. We just don't have spot price data on this platform. So gold did top out, and this would be $3,500 an ounce right up here. And right now we're at about 3,300. But yeah, you're right. Look at this. This is a $500 move in just a span of 8 trading days or so. Pretty crazy stuff. I drew a line here as what I think is short-term first stop support. That would be 3,200. We've long been saying on this channel that we think a new trading range for gold this year would be 32 to 3,400. I've got to be honest that we hit that range a lot faster than I thought. And the speed of that trajectory has me thinking the new range might be a little bit higher. But let's put it this way, 32 to 3,400 is still a valid range. We're still in there. We're at 3,300 right now. Maybe we go down to 3,200 or even a little bit below. So the conversations that we're having with people is, well, what to do now? A lot of our clients have taken our advice and have had gold and silver in their portfolio in physical form for years and even decades. We've been recommending gold for a couple decades, and a lot of our clients come to us holding gold already. And so we do think that gold is going higher, but here's a key point. if you have too much, if you feel like you have too much, this is a great time to reduce. A lot of people want to know how to hedge. I got to tell you, if you have too much gold, and too much, might be something that's a lot more than 10 to 20%. We have long been recommending 5 to 10% in of your investment portfolio in physical gold and silver. A lot of people have 20, 30, or even 40% after this move. So if that describes you, think about selling a little bit into this ramp. A lot of people complain that gold doesn't pay a dividend. In my opinion, it does pay a dividend if you sell a little bit. If you sell 2, 3, 5% here into this ramp and take the money and use it elsewhere in your life, you've paid yourself a dividend. After all, that's what it's for. So here we are at 3,300. Watch for gold to bouncing around here for a little bit. Ultimately, I think it's going to go higher, maybe 35 to 3,800 now later this year based on the charts. That is just a guess based on the charts. There's obviously no guarantees, but that's what it looks like. Let me go to the monthly chart to just remind viewers of something here. After this big 10-year consolidation, and this is the 20-year chart, by the way, the 2011 consolidation that basically went to 2020, and then we ended up in a sideways market here. This sideways market, this top, this top, this top, all three of those points were triple tops at $2,000 an ounce, roughly, on gold. And we were saying back here, watch out for this break because triple tops don't normally hold. Well, in hindsight, it certainly didn't hold. In fact, it was an acceleration point. And gold went from 2,000 now up to 3,300, and it did it in a little over a year. So you can see that this has gotten pretty parabolic on the monthly chart. So expect it to pause, but still here, if you don't have any, think about getting some slowly. If you have too much, think about selling some slowly. You have to be okay selling into an up market and use that cash in your life. So I'll pause just for a quick second here, Adam. I'd like to just make a couple points about silver, if I could too, but before then, I'll see if you have anything that you wanted to say.
No, no. Why don't you do that? I was going to ask about the miners and silver. So why don't we start with silver first, which I'll say is probably the disappointing child here in most folks' precious metals portfolios.
All right, so I'm going to change over to the silver chart here. And I also have another PowerPoint presentation I want to go to that shows the gold to silver ratio. So here's silver on a monthly chart. One thing I want to point out, and it's not as clear on this chart of silver, is that we have a similar triple top going on here on silver. It's right around $33 to $35 an ounce. On this ETF, it's right around this $31 level. Let me go to the weekly chart, and it'll be a lot clearer. Really here, and I think here is a similar triple top on silver. Silver has been relatively disappointing. The silver to gold ratio has recently shot up. I'll show that chart in just a moment. But silver, today is up a good amount while gold is down. A little bit of that disparity is correcting today. But if silver can get through this $34 to $35 level here, and it's really close to it right now, let me go to the daily chart. You'll see it even better. 1, 2, 3 tops. If we get through there, it could serve as an acceleration point, similar to what we saw on the longer term gold chart. And let me just stop sharing for just a moment because I want to go to that other chart that I just mentioned a minute ago. This is a longer term chart going back about 30 years. I don't know about you, but my eyeball says, well, the range is somewhere around 60 to 80 over the last 25 to 30 years. There's been some variations below and above. Look what happened back here in COVID. We hit 120. That was a great opportunity. We're currently right here at around 100. Actually, let me zoom in this chart a little bit here. And this is now just from 2020 to now. You can see that we touched the other day right about 105. So I calculated that this morning. We're at 97. So that ratio is oftentimes, there's no guarantee, is oftentimes it's an indication that there's an opportunity of silver relative to gold. There's a pretty stark difference today. As I mentioned, silver is up close to $1 and gold is down 70. So that's what brought us from about 105 down to about 97. So if we get back down to 80 or so, that could be a nice tailwind for silver, assuming that gold doesn't collapse along at the same time. But if we're right and that gold continues sideways here for a while, we think that silver could have a very good opportunity, particularly if it blows through that triple top that I just pointed out. I know I didn't talk about miners yet, and I'll be happy to do that too if you want to.
Oh yeah, let's talk about miners real quick. So one of the so I've been shining a bright light along with you guys on the potential for silver to have a real big catch-up move here, and historically it does. Usually gold moves first, and then usually the miners then follow gold, and then silver follows thereafter. So we had the miners really lagging gold's percent increase until a couple months ago, and then they've finally stepped into their historic levered status on the price of gold. So maybe we are just seeing, a delay in the whip crack here, and that silver may eventually be that tip of the whip that moves last but moves fastest. But one thing that I have heard, and I don't really have a strong opinion on this yet or not, is, well, it might be different this time with gold in the fact that gold is Basel III, the new Basel III banking regulations are making gold a tier one asset. And so that might be something that is giving gold additional attraction that silver is not going to benefit from, right? Silver is not going to be a tier one asset. And so that's an argument for, well, maybe the gold silver ratio should be higher going forward than it was in the past. Just curious if you have any thoughts on that.
Yeah, I think that's a relatively legitimate, Adam, and also the fact that silver is an industrial metal may be holding it back. These worries about tariffs, really could, if they stick, could slow global trade to a halt, and that really could infect or affect industrial metals more than precious metals. That would include copper as well, which is hovering around, I think, $5 a pound, and which that chart looks like it's going to go higher too. So yeah, I think that's legitimate, but who knows exactly what's going to happen in the short term. It's just that we think that's what gold is basing out here. We don't think we're going to collapse back to 2,500. We think it's basing out 3,200, maybe 3,100, something like that, certainly north of 3,000 an ounce in our view. And it's very unlikely for silver to stay at these levels. So our bullishness on silver has to do with the gold silver ratio, yes, but more so it's the technical aspect of those charts and the fact that these metals often trade in a parabolic fashion, in a short and compressed style. And I'm just noticing on the silver chart, if we get through that recent place that I just mentioned there, 34, 35, we should catapult right up to 40 or so, just like
Okay.
gold did. And they seem to be on different time frames. A lot of people are puzzled. Why aren't they moving together? Well, maybe it's just building a wall of worry. Maybe it's building frustration. Who knows? Whatever reason it is, technically the setup is there. We have to see if it happens though for silver.
All right. Well, I know a lot of people watching this, myself included, would love to see silver play that catch up. But yeah, that argument seems to mostly be based on technicals, historic relationships. So talking about the miners, we can make a really good story now about the miners from just a fundamental perspective, right? Which is what, Wall Street loves the most, right? Which is cash flow. Gold has moved so far, so fast now that unless you're just trying to destroy value at a mining company now, you should be making a fair amount more profit, right?
Absolutely. And earnings season just kicked off the last couple of days, and we have the largest gold mining company reporting, I think tonight or tomorrow, Newmont Mines. And Newmont is the only gold stock really in the S&P 500. And so it's a really small space. There's a lot of other stocks that have been leading this recent charge, like AEM, Agnico, Eagle Mines, WPM, Wheaton Precious Metals, even FNV, Franco-Nevada has really taken off as well. So a lot of these names have taken off, but the earnings, we haven't seen any big earnings surprises. The last couple quarters earnings for Newmont, for example, have been a disappointment. And so Newmont traded from the high 50s down to the low 40s, even the high 30s. But we're back here again right now. Let me just see where we're at. We're right at 53 right now. So a positive report tonight could propel Newmont to new highs, and if so, could drag these miners up. So mining shares have a multiplicative effect to their profit or their bottom line to the price of gold. There's some disagreement as to what the all-in cost for extracting gold out of the ground is, but it's somewhere around $1,200 an ounce, $1,400 an ounce, depending upon the mining company. You can imagine the profitability up here at
Oh my God.
$3,000,
Well, yeah, and just the growth in
3,300.
profitability versus a year ago. Tremendous.
Exactly. You know, if they don't make bad decisions like they have in the past and blow all the extra money and make bad acquisitions, then we're going to be all right. We don't know that, but the profitability is huge. I think that corporate executives probably learned something from the past. It's a very small group. I do believe that we're reaching a point where, that we should see some consolidation. GDX is up at 49 right now, but it moved very quickly from the mid 30s up to the low 50s and reached targets that we had before put on these charts. I'd be happy to show them in a minute, but we've long held intermediate targets for GDX, GDXJ. We just hit them the other day. That doesn't mean it's over. It means you've got to sit up and pay attention and rebalance your positions, hedge your positions. We just fully covered our GDX position the other day on the strength. We've got 2 tranches of short covered calls against GDX. Why covered calls? Well, because we think we're going to consolidate some or go sideways. We want to take income into the account, but we're not calling the top. For the record, we think that miners will go higher over the next year, but I wouldn't be surprised to see several weeks or even a month or two of consolidation here, particularly if gold consolidates.
Great. And I just want to quickly explain for folks who may not be super familiar with covered calls, just to underscore the craft that you guys apply there at New Harbor, which is you guys use options conservatively there, mostly to provide downside protection, right? So these might be puts so that if you have a big position, if that position goes against you, you've got some downside insurance that'll cushion the blow, right? Another thing that you guys use are covered calls, which is if you have a big position and it's doing well, but especially if you expect it to kind of consolidate for a while for the price to not move all that much. You buy covered calls, and essentially what that does is it lets you get income off of that position, as you mentioned. And the only quote unquote downside is that the underlying stock does better than you expect and it gets called away from you, meaning you still get a check for it at a higher price than it trades today. And you're just left sitting on with cash versus with the underlying stock itself. And if that were to even happen, you could just decide to buy back in if that's what you really wanted to do, right? So it's not a very high downside risk scenario. And if the stock does consolidate for a while, meaning that the price doesn't go up all that much, you're getting additional income off of it that you otherwise wouldn't be getting. So these are all the types of things, folks, that a good experienced financial advisor can add to your position beyond just being simply long an asset. So, all right, Mike. Sounds like you got a chart there of the miners that you should add, you want to show us here. And as you're pulling it up, I want to just mention one thing, which is, to me, it seems that we may see a bit of a renaissance in mining here in the U.S. This administration, has long talked about being drill, baby, drill. I just listened to an interview with the Secretary of the Interior, and he's really telling a story of mine, baby, mine. And a notable development is that there's been a copper mine, apparently one of the largest potential copper mines in the world that's been, or copper deposits in the world that we have here in the US. It's the Resolution mine, if my memory serves correctly. And I can't remember which Western state it's in. It might be Arizona, I could be wrong. But that has been in permitting for over 30 years. It's been an example of just how hard it is to get new mines, new substantial mines opened here in America. And apparently, the release I just read yesterday was that apparently the red tape's been cut there by the new administration, and I guess in 3 months or so, they're going to have everything they need to then be able to proceed to really start opening the mine up. So I might have gotten that story a little bit wrong, but that's pretty much the spirit of what I saw in the news. If that is to be true, and I believe that mine is owned by Rio Tinto and BNP, that would be a really big deal and a really big signal that there might be a lot more opportunity here in the States than there was previous here, and that should hopefully reflect well in the mining complex as well.
I think so, Adam. I can't pretend to be a copper expert, but or copper mining expert, but there's ETFs like COPX that do trend along the same rough shape on the chart as gold and silver miners. But copper, taking a look at, we've studied its chart. It also looks bullish, just like gold and silver does. So mining in general makes a lot of sense. And our technical indicators are telling us that commodities right now and companies that produce commodities are, in a very early sense, leading the pack. So over the last few weeks, we've noticed the commodities group move to the top in terms of the signals and the system that we use. So we're watching very closely all commodities. We have a 5% position in commodity futures through an ETF in our model. It's done really well. Of course, gold and silver aren't hurting, but in general, commodities are performing, and that's even with oil being relatively weak over the last few weeks. So let me show the GDX chart, and then if you'd like, either John or I can go through a couple comments on the S&P and the NASDAQ, because it too is doing a lot of interesting things. So here is GDX on a monthly scale. So, we've had this long consolidation. It took so much patience to stay in this. And so kudos to anybody that stayed in miners all this time. We're finally getting up to intermediate targets. We've long had an intermediate target right here of around 50 on GDX, a little higher on GDXJ. I think GDXJ was right around 65 if I flip over to that chart. But let's stick on GDX here for a minute. Let's go to the weekly chart, because on the weekly chart, I have put in these levels. It's actually 49 that I wanted to put this here, the levels of our hedges. So we were a little early. We sold some calls on GDX at 49 here. But a couple days ago, we went up to here, we sold 55. So we have May 49 calls sold and May 55 calls sold on GDX, and that's on half each. And the way that works is you say, okay, I'll be happy to sell half my position at 49. And we got roughly $2 a share for that, which means 49 plus 2 is 51. That means we were capped out at 51. Well, a week or so later, we shot up to 53, and we said, you know what, we're getting very overheated here, and gold is going parabolic. We don't want to try to call a top, but we want to bring some income in to hedge. So we sold calls on the other half up at 55. And that gave us upside to about 57 almost, because we took a dollar something and close to $2 for that. So now we have this thing completely written here, and we have a pullback going on. And there's no real telling what's going to happen here. But if I had to guess, we're going to bounce around a little bit here. Let me go to the daily chart. We just basically closed this gap, or came close to closing this gap. I think we're going to chop around for a while. And so what covered calls can do, and here's the two levels that we'd have to sell at, they can bring all this cash into the account. And, if we don't go higher, you get to keep the cash. If we do go higher, you still get to keep the cash, but you may have to adjust these levels as we get closer to expiration. So that's what's going on with miners. We think the easy money is probably off the table. We think that longer term, they're going higher. I think that GDX would probably go to 60 or so over the next year. That's just a guess. And we're hoping that it does, and we can walk our way up there by adjusting the strikes on our calls. So
All
I
right,
will
Mike, I got to
stop
tell you,
that.
it's so much more, it's so fun to be in a fun, exciting cycle here in the miners after so many years of them just being so stubborn and breaking hearts. Anyways, thanks for continuing to update us and giving us the audible updates every week. And it's just fun that the action's been so pleasant. I just want to make one last comment on miners in general, commodity miners in general, and then I'll let you go to the charts of the S&P and the NASDAQ, Mike, and then John will come back to you to wrap up to talk about our final topic. But a big part of what's going on with all these trade renegotiations is the U.S. realizing that it is overly dependent on other countries, especially China, for things that it is deemed essential to the national interest. And one of those things are, key commodities. And so I think we're just for that alone, I think that you're going to just see a lot more support of the domestic commodity sector here in the States because they want us to have that resilience. So that should be yet another wind at the back of this sector, which has many winds at its back. And if you watch the videos that I did with folks like Tavi Costa, long before the recent presidential election, he's got a whole litany of reasons why commodities, especially relative to equities, should probably do pretty well over the next decade. But we now have another important reason, sort of a non-market reason, right? Just the country saying, look, we just want more of this stuff here. So would not surprise me to see a lot more bulldozing of regulations and things like that to get out of the way to let mining thrive here. All right, so back to you, Mike. I'd love to actually get your thoughts on what's going on with the S&P and the NASDAQ right now, because I've got a question I want to ask you based upon my recent interview with Felix Zulauf, but why don't you go first?
All right, I'm going to bring up a daily chart of the S&P right now. Should be coming up as we speak. So here is the S&P. So the S&P, it's been a really wicked downtrend. It came out of nowhere, and as we've talked about early in this video, the VIX, or the volatility measure, shot higher and has been really above 30 for most of April. And a VIX above 30 means you could expect daily moves of 2% or more in the S&P 500. And so certainly there's been a lot of emotions, a lot of worry. People are thinking that the bottom's falling out and this is a major phase change in the market. Well, we don't really know that for sure. I can say that this has been a really compressed drop. And this is how we see it on a technical basis here. We came into this drop with not a whole lot of equity exposure in the first place. That was a conscious decision we made, basically coming into this, knowing that nobody can really tell when the bottom's going to fall out. And so that happened here, and some of our hedges kicked in right here at 5,400. So we had 40% stocks. We went to 25% stocks as we went through here. We covered that hedge down here somewhere. We're back to 40% unhedged. And we're probably not going to get too aggressive no matter what happens. But here's what the short-term picture looks like. The long-term picture is terrible. The macros are terrible. The valuations are terrible. However, we're forced as money managers, as investors, to make shorter-term and mid-term decisions based on what's going on in the market. That is, unless you're just completely out and you're in treasury bills, and that's okay too. But here's what it looks like right now. We've got a really sharp bounce here. We had a spike in volatility. We had 3 days in a row, roughly above 42 or so, I think, on the volatility. And now we've popped back up here, and we're above this critical level, or the hedge level, that we put at 5,400. Now what happens? Well, the last 2 days, we saw the market kind of shake out the last week hands, and we popped 2 days in a row. And today, it was a massive update earlier today, up 180 S&P points. Right now, we're up 120 points. So no one really knows, though, is this just a counter trend rally, or are we going to make a run for the highs? And we don't really have to know. What I can tell you is this. There is this downtrend line, which is like a magnet. This market is, when we were down here, we were thinking that we're likely going to come back, test the downtrend line. And furthermore, the 50-day moving average, which is right here in red. So 54, 55, 5,600, these are levels of resistance that, if you're feeling like you were too exposed, these are levels that you could lighten up slightly into. These are also levels, as we reach them, that we will likely raise some cash by selling calls, which is a partial hedge on our positions. And so we have to see if we eat through this level and then run. Now, if we eat through these levels and have some big up days, all bets are off. The shorts will start covering, and then maybe we will make a run for those highs. We'll have to take it as it comes. But right now, we're converging on these extremely important areas: the downtrend line, the 50-day, and even the 200-day. So let's see. So far today, it's a pretty good sign that we're up 120 points still. We'll have to see how we close. If we had a big update tomorrow, I think that would get some shorts running. But right now, all we're really doing is running into resistance zones. And I will just finish by pulling up the NASDAQ, because it's pretty similar in terms of shape. The NASDAQ has its own downtrend line. It's steeper because the NASDAQ drop was steeper, and you'd expect, that downtrend line to be steeper. And here we are again in what I'd say is roughly no man's land. And we have been there for a while with these wicked, just moves every single day. We need to see what happens really today, tomorrow. If we have a big up day in the next few days, then it's going to be a pretty positive thing for the market. So right here, watch for a slight move higher to reduce if you're feeling too heavy, and or hedge. That's what we'll be doing.
Okay. So a number of the people that I've been interviewing recently, and Felix Zulauf first and foremost comes to mind, are their outlook shows the markets kind of trending sideways from now through fall with a lot of volatility. And so what they're recommending is sort of a buy the dips and sell the rips strategy here, which is, as the markets start to recover, like you think they might, getting back up to that line, as they do, start selling into that, and then, don't really start buying unless it's really dropped down far below that. In Felix's mind, he thinks that there'll be a time later this year to go long. And so he's basically like, keep your capital largely dry, and what capital you have, buy the dips, sell the rips. But eventually later on this year, you want to start going real long because he personally has a better outlook for 2026 and 2027. Just for the next quarter or say, are you guys in a similar sell the rip type mentality?
I'd say very short term, yes, but uh, a lot of this is just gut feeling or going by experience, Adam, to be honest. I just don't think we saw enough euphoria at that recent top, and I wouldn't bet on this, but I wouldn't be surprised if the market gets into those areas that I just highlighted there, and then they just keep going. That's what's been happening again and again and again for the last 15 years. I wouldn't bet big on that. We're not going to bet on it, frankly. In fact, we're going to assume that we're reaching resistance levels here. But if we break through there and accelerate, we might make some small adjustments and add a little bit of equity. But what I think is likely to happen is that we will probably blow right through there. Again, it's just a guess. I wouldn't bet on it. We wouldn't get really big into stocks, but we will do the prudent thing because that's essentially what we do as money managers. We have to do the prudent thing. And the prudent thing is to assume that that's going to be a wall of resistance. And if we go through there, it's going to be nice. We'll probably we'll certainly underperform the S&P if we blow right through there. And then we'll be looking for a top later on. Because ultimately, again, the big picture is we think we're going to see a big market drop, if not a market collapse. And a whole lot more than the 21% we just saw. I think 50% to 70% is what we expect. I just think personally, I think it's going to come from a higher level. I just don't think we saw enough fireworks or euphoria up there at that recent high. It sounds like Felix Zulauf pretty much roughly agrees with that. Maybe a little bit different on the timeline. I think if we get that euphoric move, it's likely to happen in the next 4 to 6 months versus later on. So we're going to have to wait and see. I'd say first, hedge into that resistance area, and then if we blow through, make some different decisions.
Okay. One thing I think Felix does differ with you guys on that we can talk about maybe next time you're on the channel is he's got a pretty decent, a more sanguine outlook for 26 and 27. And I think there's a couple of things that influence that. One of which is he sees governments, not the US yet, but governments increasing their fiscal spending, right? And so he thinks that is going to be supportive of markets, which, that equation seems to be pretty well proven in recent years. Governments increase their deficit spending, their domestic stock markets tend to do pretty well, nominally at least. But we can get into that later on. But it sounds like, sort of through fall, you guys have a similar lens. All right, John, coming to you for wrapping up here. The common theme through what I've discussed with you and Mike has been uncertainty, heightened volatility, which, equals heightened emotions. I think Mike mentioned that you've got clients that are reaching out to you that are understandably, their heads are kind of spinning about with all the changes that have been going on in the markets, the huge drops, the big rebounds. What do you want to say to this viewing audience about that? Because we know that emotional decision making, especially in investing, oftentimes usually leads you to make the wrong decision at the wrong time. So what kind of counsel would you have for folks? And are you seeing folks, beginning to sort of get unduly nervous here?
Yeah, as I said earlier, we are detecting and sensing a heightened level of concern and worry from our client base. And that's despite, as I mentioned, our defensive positioning actually weathering this recent storm quite well. We barely dipped negative at any point this year for clients, and that was very short-lived. So it's a feeling rather than the reality, and the saying, perception is reality. So folks are rattled, and what I would say, so first of all, it is important not to be emotional, and that's our jobs. The seats we sit in here, that's one of our most important jobs. And how do we do that? We're human too. We take our decades of experience, our disciplined, data-driven system to tune out the emotions or put them in check, so we can be that emotionless ballast for our clients. But it's also really important to bring it back to the client's own situation. The arrogance of our industry is that we know better than you, right? I can't tell you how many clients and prospects come to us saying, I told my advisor I wanted to take less risk, and they just made me feel stupid. They belittled me. They were condescending and complained about, hey, markets always go up. Don't worry if they pull back. It's just an opportunity to buy more. Forgetting, of course, they have already got their clients fully invested and there's no cash to buy more. But it's really important to bring it back to one's own situation, because at the end of the day, many people probably will die with more money than they need. And is it worth sticking it out if you're not sleeping well? And that's where we can be an objective point of reference for them. We can help them put in the context. Don't be a hero. Take a step back. You can still do well, and we got a long time frame ahead of you. And certainly valuations where they are right now aren't screaming cheap. So don't feel like you're missing out on the deal of a century. And bring it back to what's going to help them sleep at night. And of course, we got to help them beyond emotional, but not in the way that most of our industry does, by saying just keep your money in the market. If you try to time the market, you're going to lose. That's just self-serving and frankly condescending and arrogant. We're here to help our clients and folks we talk to navigate through that.
All right. Well, folks, look, if that sounds like something that you could benefit from, then feel free to schedule a free consultation with New Harbor directly or one of the other financial advisors that Thoughtful Money endorses. To do that, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. The firms will sit down, they'll hear your personal situation and give you their tailored advice. You can do with that whatever you want. There's no commitment to work with these firms. All right, John and Mike, another great monthly check-in with you. Looking at the time here, we got to wrap it up, but I'm sure there's going to be a ton of other questions that folks would like us to dig into next time you're on, and we'll just do that. Folks, if you've enjoyed this, you'd like to see these monthly sessions with the New Harbor team continue, please let us know by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. I'm sure the wild ride is not going to calm down anytime soon. So whatever gyration it takes between now and next week, look forward to having you guys back on here next week on your usual appearance on this channel to make sense for it for us. Guys, can't thank you enough.
Thank you, Adam. We really appreciate it. We're humbled that we get to spend this time with you, and we hope we didn't bore too many viewers here. We hope you found some of what we had to say helpful and stress relieving.
And thanks for having us like usual, Adam. We really enjoy having the ability to talk with you and your viewers. So until next week, thank you very much.
All right. Well, thanks, guys. And it's worth reiterating, we have had a professional relationship, boys, going close on 15 years now. Maybe it's 14, but it's been a long
11,
time.
something like that, yeah.
Yeah. And it's been wonderful. I appreciate your partnership. And again, the thing I appreciate the most is in that entire time, I've never lost a minute of sleep with the folks that I put in touch with you. As I'm sure comes across to folks here on camera, you guys are just, high integrity, extremely earnest guys who put your clients' interests first and foremost, always. Just can't express my appreciation enough for what great partners you've been. And with that, we'll end the Mutual Appreciation Society. But thanks so much, boys, and everybody else. Thanks so much for watching.